Am I the only one who is wondering why houses got so extremely expensive to the point where most people cannot afford one? You could buy a house for $23,000 back in 1970. The exact same house today would cost you $500,000. Some people say that as the price of houses kept increasing, so did the average income. Well, let's simply take a look at the numbers. The median household income in the US was around $10,000 back in 1970, while the median house price was around $22,000. So the median house price was a little over twice the household income, which means that over the last 50 to 60 years, the median house prices increased twice faster than the median household income. So what exactly is happening here? Why house prices grew much faster than household income? Who is buying all of these houses when housing got so extremely expensive? And will housing ever become affordable again? If you're ready, give this video a thumbs up and let's dive in. Home ownership wasn't always popular in the United States. If you go back to 1970s when it was much more affordable, it was less popular than it's today. It was at around 63%. It started growing after that, maybe because people realized that we have to buy a house. That's when the idea of home ownership probably started rising, but it peaked back in 1980s and started falling down. So if you're wondering what exactly has happened in 1980s that led to the collapse of the housing market, all you have to do is to take a look at the mortgage rates. Back in 1975, mortgage rates were as much as they are today at around 7.5%. But then there was a high inflation back in 1980s and mortgage rates increased to around 20%. So if you're complaining about mortgage rates today at around 7 to 8%, then you haven't lived back in 1980s. And a single percentage in your mortgage rate is going to have massive influence in the price of the house that you buy. Let's say for the sake of example that you're going to buy a $300,000 house. $300,000 wouldn't actually get you much in a place like California or New York, but it's a decent amount of money to buy a house. So at 3% interest rate, the total price of the house is going to be around $450,000. So you're overpaying by around $154,000 over a period of 30 years. If we take the exact same house, but at an interest rate of 7%, suddenly your monthly payments are going to grow to around $2,000. In a place like California or New York, where you can easily make $4,000 or $5,000, it might not be a big problem. But you can't actually get a house for $300,000. You can only get for something really great or something really decent for at least $1 million. In places where houses are around $300,000, so are incomes at around $3,000, $4,000, $5,000 at best. But look at what happens at the total price that you pay at the end of 30 years. It grows to around $718,000. So you're paying more than double the price of the house because the initial price is around $300,000, but this is the money that you pay because your mortgage rate have increased to 7%. And now let's compare that to what was happening back in 1980s when mortgage rates were 18%. Your monthly payments would go to $4,000. In fact, it's $4,500. And the total price of the house will cost you at the end of 30 years $1.6 million. So when you're buying a house, the most important factor that you should be paying attention to isn't always just the price of the house, but the mortgage you get. Even a single percentage will cost you hundreds of thousands of dollars. And now imagine if you're buying not a $300,000 house, but you're actually buying $1 million house. The difference is going to be substantially bigger. And here's where everything gets interesting. Around 60 to 80% of all the houses that are being purchased in the entire United States are being financed by a bank. Most people cannot afford to buy a house. That was the case back in 1970s, 80s, and that's the case today. So when an average person goes to buy a house, they don't go with a suitcase of cash in order to buy that house. They would go to the bank, get a mortgage, and then buy that house. That's the vast majority of the United States. So when mortgage rates started going down over the next couple of decades, it seems great. People buying houses, people making a lot of money, and everybody is getting rich. That's exactly what we want in the United States to happen. Everybody can afford a house. but it turned out into a complete disaster that almost wiped out the entire US economy. By the year 2004 and 2005, mortgage rates were at around 5%, which is actually not really fantastic compared to what we got in 2020 and 2021, but that's way better than 10, 12, or 15%. Mortgages became so popular back in the days that in 2006, 92% of all the houses in the market have been financed by a bank. So 9 out of 10 houses that are being purchased in the market have been backed by a bank. Wall Street started taking these mortgages, they packed them in a really great package and started selling them as securities to other investors. Those securities have been selling like cakes. So because the demand for these securities was so high, the banks kept giving more and more loans to the point where the entire market was financed by a bank. Everyone believed that we can keep giving these loans as long as there is demand for these houses, to the point where one day everybody will have a house in the United States and houses no longer will be a problem. Everyone can afford right now. But then the 2008 financial crisis actually happened. Too many houses and too little demand. The crash of the housing market led to the collapse of the banks because nobody is actually paying their mortgages right now. And when people stop paying their mortgages, the banks actually collapse. When the banks collapsed, they took down with it the entire economy. When the entire US economy went down, it took with it the entire global economy. So the 2008 financial crisis didn't just hurt the United States, it hurt the entire world, especially when we talk about Europe, whose economy very depends a lot on the US economy. It didn't literally hurt much China because China was actually at its prime and it was growing tremendously. They didn't see the outcome or the consequences of the 2008 financial crisis, even though that they suffered to a certain extent as well. The blue color is monthly supply of new houses in the US. And as you can see that as the demand for houses back in the year 2000 started growing, so did the supply. Everybody saw an opportunity to build a house. When you see that people want houses, you as a builder start a business in order to build a house. If you have a business, you realize that there is demand for houses, you start building more houses. And the demand or the supply of houses back in 2006 and 2007 went tremendously high. It has never been as high as it was back in 2007. And then in 2010, it collapsed and nobody wants actually to build new houses because nobody was actually buying houses. When the government realized that the housing market is crushing the entire economy, they had to step in and do something. They had to stimulate the demand. That's where the problem actually was. First of all, we have to save all of these corporations that are actually being drowning in all of these debts, especially when you talk a lot about the banks. And what does the government knows how to do the best? Exactly. Printing money. That is the best thing that the government can do. The Fed printed $3.7 trillion in quantitative easing program. The second program was emergency lending program. That was around $2 trillion. But since $6 trillion was already a lot of money, the government started creating new type of programs in order not to call it direct printing money, but they actually started loaning and lending money to the economy or injecting money to the economy through different kind of programs. One of these programs was TARP, Troubled Asset Relief Program. $700 billion, throw it into the economy and save these assets. Another popular program was American Recovery and Reinvestment Act, where the government directly started investing in businesses at around $831 trillion. If you take all other programs individually and combine them in total, they would worth around $2 trillion. So if you look at all these numbers, suddenly you realize that the government printed something between $8 to $10 trillion. The median house price back in 2007 was around $257,000, and it fell to around a little over $200,000. So the fall was at around 20%. If the government did not step in and the market was flooded with more houses but very little demand, prices would have actually fallen to the point where everybody could buy a house. People with an income of 1 year could take their income and simply buy a house. That could be the situation back in the days, but the government did not allow that to happen by overflooding the market with so much money. And all of these trillions of dollars didn't actually fix the problem, because for the next 8 years or so, home ownership kept falling down. And back in 2016, when the shift happened and home ownership began to rise. And this was 2020 when they actually dropped the interest rates to almost like 0%, and you could get a mortgage for like 2.5%. In 2008, the government decided that we have to take a long list of actions in order to make sure that the US economy is not going to suffer something like that again. They introduced some regulations, or maybe a lot of regulations, that made it much harder to build. If you want to build a house, then you have to do A, B, C, D. In these cities, you can only build this kind of houses. These are extra safety measures that you have to do. But before building a house, you have to take permit. And these permits will take forever for you to actually take them. And it's not just one permit, 2, 3, 4, 5, and for every single thing. So when you're doing business and building houses, suddenly the cost of building a house is going to rise because of these permits. Suddenly you have to follow these regulations, which makes the cost even much higher, and house prices are going down. Will you keep building houses? Well, of course not. Suddenly you will abandon this business and you will do something that is much more profitable. So a lot of companies that started building houses started leaving the business, and the supply of new houses in the market started tanking to the bare minimum. And you can clearly see that in the numbers that we have over here. Look at 2010, 2012, 2015. It only recovered back in 2014 when supply of new houses started growing again. And it didn't really grow that much because only large corporations could do that. The introduction of the Dodd-Frank Act also played an important role. Remember I told you that the most important thing in the housing market are the mortgage rates? And if you want to buy a house without a bank, for most people, it's literally an impossible job to do. Suddenly the government told the banks that if you want to loan money as a mortgage, here is a very long list of requirements that you have to follow. Suddenly, most people, the vast majority of the population, cannot get a mortgage because they do not meet the requirements that the government put. And the governments and the requirements they put in place, they made sure that they only loan mortgages to very responsible people. So if there is some doubt about your background, about your income, about your ability to pay off your debt or your mortgage, then you're not going to get that mortgage in the first place. Will housing ever become affordable again? Now, in order to answer this question, we simply have to take a look at who is interested at affordable houses. You might be interested, and that is very understandable because you want to buy a house. But if you actually look at the entire economy, most people are not actually interested in that. First of all, homeowners. If somebody is a homeowner, he doesn't want the value of his house to go down. You want the value of your house to keep growing. Especially if you actually took a mortgage to buy that house. If the value of your house goes down, then that's not in the best interest of you. The higher the price of your house goes, the more wealthy you're going to become. So you're specifically interested in all of these regulations that the government put in place in order to make sure that more houses aren't being built and the value of your house goes up. How about builders? We have a limited amount of builders within the economy right now who are building most of the houses. And if they actually lose up the regulations, then there is going to be a lot more competition and they will lose their business to the smaller players that will come into place. And they don't want that. That's why they will finance lobbies, they will finance politicians to make sure that they don't change regulations, and it will be much more difficult to actually get into the game, so they keep their monopoly in that industry. Investors, of course, they're not interested. They want to protect their investments. They want to make sure that the value of these houses go up and the value of the rents also go up as well. So they keep actually renting them out and make a lot of money out of it. How about the government? The government is also not interested in that. So the only person who is interested in lower house prices is you, the person who cannot afford these houses. But if you work super hard, and someday you will be able to afford a house, you will become a homeowner, or you will no longer be interested in lower house prices because now you are a homeowner. And that's why nobody within the entire economy is actually interested in lowering down those prices. The only way to lower down these prices is by increasing supply or by lowering down the demand. the demand is not going to go down. Back in the days, they decided that it's much better to take house prices out of inflation data or out of the CPI data. So if you take it out of the CPI data, it's no longer in the inflation report and nobody cares about that at the top. So house prices can grow tomorrow by 50% and CPI report does not care about that. It's not part of inflation. It's not part of the government to make sure that house prices don't grow that much. The only hope that people have to be able to afford a house is for mortgage rates to go down, but they're not going to go down. There is a lot of conflict between the Fed and the current president of the United States who wants to lower down interest rates, but even lowering down interest rates might not always lead to lower mortgage rates because mortgage rates have a lot more factors besides just interest rate. For example, the risks, how much house prices are going to increase in the future, because it's not the Fed that is giving you that mortgage, it's the bank that is giving you that mortgage. And if they believe that house prices will actually tremendously increase in the foreseeable future, then they will actually offer a much higher mortgage rates. And this is just one out of many factors. While buying a house is one of the most important investments that most people will make in their entire lives, if you cannot get into that, you might actually get first into the stock market, because to the stock market, you can actually get with as little as $1. And through the stock market, you can already start accumulating wealth, and later on, you can use that wealth in order to buy a house. And maybe you might not even have to buy a house because you can make far more money from the stock market than you can actually make with a house, and your stock market investment can pay for that. That's just one option for people who are actually looking to start building wealth, but they cannot afford to buy a house. And if you need help with that, make sure to check the first link in the description. Thanks guys for watching, and see you in the next one.